I'm James Wagner, and are you drowning in debt? In our last session, we talked about the virtues of budgeting. No doubt there was a wise place to start. Budgeting deals with events of today and tomorrow. It helps us avoid mistakes of the past and helps us set up and achieve our goals. But debt represents financial mistakes of the past. When debt is good and when is it bad? When are the virtues? Let's get started, and we're going to talk about that now. Economic theory holds that borrowing money is smart when prices of goods and services that we're purchasing are rising faster than the cost of borrowing. Take, for example, back in the 1970s when inflation was raging at more than 12%. If you could borrow money at less than 12%, that was smart because you were paying the money back in devalued money. But things have changed dramatically. Starting around the year 2000, the inflation rate has averaged a mere 3% and sometimes even less, while more and more consumers are borrowing using their credit cards at rates oftentimes as high as 28%. That's no longer smart. Today, debt is no longer an asset. Today, we're going to cover the many twists and turns of debt. How did we get it? How to lose it? How to get it back? And perhaps most of all, how to get rid of it. We want to thank our friends at Experian for providing us with the inside scoop on how they go about calculating your credit score. In the second part of our program, we're going to take a laser focus on credit cards. Yes, those little pieces of plastic that can give us so much instant gratification, but can cause so many problems. First off, an admission. I believe if it's true that money is the root of all evil, then debt is the devil himself. But we're going to try to remain as objective as possible during this discussion, noting that debt by itself is generally not a problem. It's how we use it, or should I say misuse debt, that causes the problem. In times of prosperity, when our prices of our homes are rising and we're bringing home a nice paycheck, maybe even overtime, a year-end bonus, that sort of thing, in those kinds of times, when the news about record high stock prices are there, that's not an issue. In fact, to some extent, it's smart to take on debt if the object of what we're buying today is going to go up in value faster than the rate of interest that we're paying on the borrowed money. But this has long been the guiding principle of home ownership. But how much debt is appropriate to our individual circumstances? It is when times become difficult that this question becomes really important. And for the past few years, this is the climate that the whole U.S. economy has been facing. If you live in one of the most severely impacted areas like California, Nevada, or Florida, for instance, you really know what I'm talking about. So how did we get to where we are today? First up, how do we go about acquiring debt? Well, that's the easiest part of today's discussion. You know, when my father was alive, just after the Great Depression, if you wanted to borrow money, you needed to have a steady job, have a savings account, and be known at the local bank by the lending officer. Today, as many of you know, all you need is a name and an address. And it doesn't have to be your real name in order to receive an offer of credit in the mail. And you don't need to even use the mail. That's okay too. You can go to any number of websites on the internet and apply online and get almost instantaneous acceptance. Even if you filed bankruptcy and have no job, no problem. There are credit card lenders out there that are ready to provide you with a card. For a price, of course. It's virtually impossible to lose access to some lender. But at what cost is the credit? The answer depends on your FICO score. Your FICO score is the most common type of personal credit score, and it's used in some form or another by most lending institutions. The FICO score tells lenders in a very simple way how likely you are to repay your debts and repay them on time. Ranging from 300 to 850, your FICO score is calculated according to a formula developed by the Fair Isaac Corporation, hence the acronym FICO. There are secrets to optimizing your FICO score and thus getting the lowest interest costs on your loans. It helps to understand how the system works. And here are 4 major factors. First up, how you pay your bills. That's 35% of your score. How consistently have you made your payments on time? Have you paid your bills late? How many times were you late? How late were you? How much money did you owe? Have you ever had a debt in collection? What was the size of the debt? Have you ever filed for bankruptcy? Next, your total outstanding debt, and that's 30% of your score. Outstanding debt is debt of all kinds, including mortgages, car loans, credit cards, home equity, lines of credit, and any other loans that are reported to a credit agency. Another important factor here is how much unused but available credit you have on your credit cards. The absolute amount of credit you have is less important than how close you are to maxing out the credit you've been granted. The highest scores go to people who use credit sparingly and keep their balances low. Credit history. This is 15% of your score. The longer you've had and used credit, the higher your score. You get even more points if you have established long-term credit with the same lenders, a reason why you might not want to close out those long-term credit cards even if you don't use them very much. Mix of credit. Now this is 10%. It's very small, but it's important. Your score is higher if you have a variety of fixed payment loans and revolving credit. Recent applications for credit. This is one thing that trips up a lot of people. It accounts for only 10%, but it's very important. And it's the number of applications for credit over a short period of time, and that raises a red flag for lenders, as it is often a sign of a person who is in a cash flow problem. The FICO formula takes a point away for this. Multiple applications for specific types of credit in a concentrated time frame. When you're rate shopping for a mortgage, for example, don't count against your credit score. So the trick to optimizing your FICO is paying your bills on time and then keeping your borrowing as low as possible in relation to your credit limits. So to game the system, we have as many accounts as possible, because it's better to have $10,000 in debt from 10 different parties than to have only one lender. A special note about department store accounts. Most department stores report customer outstanding balance to be equal to their credit limits. That's very important. So if you've charged, for example, only $50 on your Macy's charge, at the end of the month, Macy's would report that you had used 100% of your credit limit for that period. That, my friends, is dirty poker in the credit game. So let's use this wise knowledge to our advantage and avoid those department store charge accounts if you want to maximize your FICO scores. Otherwise, enjoy Bloomingdale's, enjoy Macy's, spend to your heart's content. Now, let's talk about raising your FICO scores. Now, generally, any score above 720 is considered a strong score. I've yet to meet anyone who has a perfect 850, but I'm still looking. The further that you go down towards 650 or below that, the more costly it is likely to be for you to borrow money. Sometimes I found my FICO score is temporarily depressed if I've aggressively applied for a bunch of low-cost credit cards, and such usually changes within a month after I stop. Other corrective actions tend to take longer. Here's a list of what you can do. First and most important is always pay your bills on time. Next, make more than the minimum payments required, especially toward credit card accounts where balance is close to your credit limit. Transfer a portion of the balances you have on cards that are nearly maxed out to cards where you are well below the limit. Challenge any inaccuracies on your credit reports. You're entitled to a free credit report every year. Check it at least that often to guard against mistakes. Now, credit cards often get a bad knock by financial experts, but I take the opposite side of the argument. I know for a fact that credit cards are the greatest financial instrument ever invented. The problem is that they're the greatest instrument for the banks that issue them, but the worst form of consumer slavery ever. In a single year, American consumers pay more than $250 billion just in interest charges for starting a $2 trillion credit card debt. This is truly an addiction. When we look back less than 20 years ago, in the early 1990s, when this type of debt was only a few hundred billion, we can safely say that no other component of our spending has increased so dramatically. So what can be done? Well, here are a few ideas. Cut or shred your credit cards, or at least put them away until your balances are paid off in full. Substitute cash or debit cards that will put a limit on your spending. Pay the balances in order of the highest interest rate to the lowest. Add your minimum payments and then determine how much more you can budget to pay down those debts. Use these additional funds to pay off the debt with the highest interest rate. Once that debt is paid down, start paying down the debt with the next highest interest rate, continuing until all the balances are paid off completely. Next suggestion, look for a lower interest rate credit card. You may find an offer that contains a teaser rate that is only available for a limited time. You can transfer balances from your high interest rate cards to the lower interest rate and then pay off the balances as aggressively as possible. Before getting the new card, however, make sure to review all the details. The low rate may only apply to new purchases or to transferred balances. You're going to be looking for a card that will apply the low rate to transferred balances. Also, check if there are any balance transfer fees. Once the teaser rate is over, either find another low rate card or call the company to request a lower rate on that card. Consider using a home equity loan to pay off your consumer debt. Home equity loans typically carry a lower interest rate than other consumer debts, usually around prime to prime plus 1 or 2%. And as long as the balance does not exceed $100,000, interest paid on home equity loans is deductible from your income tax returns. You will find it harder to get a home equity loan than it was in the past. Now, lenders are likely to restrict loans to value ratios of less than 90%. They might even require higher credit scores. 680 or more is probably the standard break point, and may even require a full appraisal of your home. However, when available, home equity loans can offer interest rates of about 4.5% to 5.5%, compared with a typical credit card interest rate of 12% to as much as 28%. This method, when available, is a most potent tool to interest expense reduction. For example, if you have a $50,000 credit card debt and are suffering a 28% interest rate, your monthly payments will be about $1,166. Now, if you refinance using a 5.5% home equity loan, your payments would only be $229. In other words, with a single transaction, you could be freeing $937 each month that could be put into savings, or just over $11,000 a year. Take that over 10 years, that's real money. There are several important things to keep in mind. The method suggested above will not get you out of debt. They will only help to lower your cost of debt and get you some tax benefits in the process. You must first create and adhere to the budget that we covered in episode 1. Raising the credit card debt is a clear sign that spending is exceeding income. Once credit card debt begins to accrue interest, the likelihood that you will ever pay off the debt in full diminishes with each passing month. There are only two real solutions if you find you must use credit cards. First, use only credit cards that have a 25 to 30-day grace period. Secondly, pay the balance in full each month. We're about out of time, but before we close, a word on outside sources, things like credit repair, mortgage modification companies, and other services that charge an upfront fee for their services. And the word very simply is, avoid them entirely. There is no proven track record that any of these types of firms have consistently delivered on their promises. Even the so-called debt renegotiators that charge a fee only when successful can charge as much as 15% or more, and that's of the outstanding balance. And the impact is very likely to severely depress your FICO score for a long period of time. Okay, that's all we have for this time. I'm Jim Wagner. Please join us on our next session when we're going to take on the subject, banks and bank robbers. How safe is your money? See you then.